Is Roger Hutchison, along with my son, going to help me through this presentation. And today we're going to talk a little bit about fear in the stock market and how we deal with that, and maybe even make some money from it. And before I get too much further, I just think it's funny because the investing dad concept is, because I'm an at-home dad with a son, and trying to do something that'll bring an income for the family at the same time as being a at-home dad. And just like the transitions, some of you are probably familiar with. Like I just went from reading the Clifford book, and I'm Emily Elizabeth, and I have a dog. My dog is Big Red Dog, and then you go from that to talking about options. And anyway, it's just kind of an interesting brain tweak that's taken me a while to get used to, but I can do better now than I used to. But anyway, back to fear. So we have fear in the stock market.
Hi.
Yeah, you sang hi. And fear in the stock market, which causes volatility, which if you've been watching the news, you've heard a lot about volatility. And you may have even heard about the fear index, which is the VIX, V-I-X, and you can look that up. And it's at an all-time high since they've been recording this for 20 some odd or 30 some odd years.
Hi.
And
Hi.
so what does that mean? It's like, okay, everybody's freaking out, and so what do you do with that? How do you make money from that? Well, the way options are priced, stock options, not like stock options you get from your company, but options that you can actually buy. Volatility is built into the equation. It's called a Black-Scholes equation that prices these things. So it makes them more expensive if you are buying the options, but on the flip side, you can make more if you are selling the options. So one strategy that seems to be consistently good for dealing with, for taking some advantage, making a little bit of money off of the volatility, the fear, is to sell these options. And you do that with what's called a credit spread. And with the credit spread, you essentially sell an option. That's what they call out of the money, that you hope that it stays out. Basically, it means if you have a security or stock that's worth $10 and you think it's going to go, or we'll make it $100. Yeah, hi Nathan. It's $100 and you think it's going to go down, then you might buy an option at 100 or sell an option at 110, collect the money for that, and then to offset the cost, because it'll still be expensive, and because of the way the rules work, you might sell one at 105 and buy one at 105, 110, and it sort of offsets the cost of what you are selling. Trust me, it works out. And then you basically get to collect the difference between the prices. And the money shows up as a credit in your account, but you don't actually collect the money until the options expire. Because options have an expiration month. I'm going to have to end this real quick. So the options have an expiration month, so you want to do this within the same month so you can collect your money within the same month, and you're fairly confident that the underlying stock value, say at $100, is going to continue to go down within that short time period and not go above the options that you sold, because you don't actually have them. And it's because if they did, then you'd either have to back out of the trade or come up with the stock and sell it to the person for the strike price of $110. So that's not something you want to get into. So as long as it's trending down, you get to collect your money when the options expire. So it works better when there's more volatility, like right now, because because the volatility is a number that's built into the equation that prices options. You're selling options, you make money off that. Okay, sorry if that went too fast, but I think he wants to do something else. So good luck. Talk to you later, and weekend's coming up, so enjoy it.